Every crash begins the same way, with confidence. People believe they've finally solved the chaos of markets. They believe growth is permanent, risk is manageable, and pain is optional. Then, like clockwork, the same story unfolds. Easy money, speculation, euphoria, and denial. It happened in 1929, when ordinary Americans borrowed to gamble on stocks. It happened in 2008, when cheap mortgages turned neighborhoods into casinos. And it's happening again in 2025, just under a different disguise. The names change, but the behavior doesn't. Back then, it was railroads, radio, and real estate. Now, it's AI, crypto, and tech giants promising endless growth. Every generation swears this time is different, that innovation or policy or intelligence will save them. But the charts, the psychology, and the math all tell the same story. The pattern is repeating. Before every collapse, the signs appear. Markets decouple from reality, credit explodes, media optimism peaks, and warnings are mocked as fear-mongering. The crash doesn't start with panic, it starts with applause. Because at the top of every bubble, greed feels like genius. This isn't a prediction, it's a pattern. And if you understand it, you'll see that history isn't repeating. It's rhyming louder than ever. The only question left is, how close are we to the final verse? Every financial crash begins with one deceptively simple idea. Money should be easy. It's the spark that ignites every boom, every bubble, every illusion of prosperity. Central banks slash interest rates. Governments inject stimulus. Credit flows freely. And suddenly, everyone feels richer. Not because they've earned more, but because borrowing has become effortless. This phase always feels like a golden age. Borrowers believe they're being rewarded for ambition. Investors think they're smarter than ever. Corporations borrow billions not to innovate, but to buy back their own stock. The media calls it growth. Politicians call it progress. But it's not growth. It's leverage disguised as stability. You can trace this same pattern through every major crash in modern history. In the 1920s, the Federal Reserve kept rates near record lows, flooding markets with credit. The result? The Roaring Twenties, a decade of speculation that ended in ruin. In the 2000s, cheap mortgages fueled by subprime lending convinced millions that home prices could only rise. We all know how that ended. 2008, and now, in the 2020s, zero interest rates, pandemic stimulus, and quantitative easing have inflated the largest financial bubble in human history. The dangerous part is how normal it feels. When money is cheap, risk feels invisible. Everyone borrows, everyone spends. The economy looks unstoppable, but underneath, something fragile is forming. A foundation built entirely on debt. Every dollar printed is a dollar borrowed from the future. And the more liquidity the system absorbs, the more unstable it becomes. The signs are everywhere in 2025. Household debt is at record highs. Corporate debt has surpassed $12 trillion. The US government is adding roughly $1 trillion every 100 days. Banks are quietly warning about defaults. Yet the stock market keeps rising because easy money creates its own gravity. It pulls everything up, even as the structure below begins to crack. At first, everyone celebrates. Real estate prices soar, tech stocks double, crypto rebounds. The public mistakes monetary inflation for economic strength. They believe the wealth is real. But every boom built on borrowed money ends the same way, with the bill coming due. This is the first horseman of every crash. Easy money. It starts with hope and ends with fear. It feels like opportunity but hides decay. And once the addiction to cheap credit takes hold, the next stage of the pattern always follows: speculation. Once money becomes easy, the next transformation begins. Investment turns into speculation. The line between building wealth and chasing luck disappears. In this phase, people stop asking whether something has value. They only ask how much it went up yesterday. Rational investing dies, replaced by the oldest drug in finance: greed. In 1929, Americans mortgaged their homes to buy stocks on margin. In 2008, people with no income were approved for multiple home loans. And in 2025, investors are doing the same thing with AI stocks, crypto tokens, and leveraged ETFs. The language evolves, but the psychology never does. Everyone believes they've discovered a smarter, faster way to get rich, just like every generation before them. This is when the system begins to detach from reality. Margin debt explodes as traders borrow to amplify gains. Speculative assets outperform everything else, not because they're productive, but because they're addictive. Financial media glorifies 22-year-olds who made millions overnight. YouTube, TikTok, and Discord turn speculation into entertainment. Memes replace math, and everyone becomes a financial expert, until the moment they're not. The illusion of intelligence spreads faster than ever. Algorithms feed the mania, influencers pump coins, analysts justify impossible valuations, and economists rebrand bubbles as innovation. This is the modern version of the 1920s ticker tape frenzy and the 2000s real estate flipping boom. Only the setting has changed. The psychology is identical. Meanwhile, the smart money, institutional investors, hedge funds, and insiders quietly begins to exit. They recognize the pattern. They've seen it before, but their selling is drowned out by the roar of retail enthusiasm. The average investor sees rising prices and thinks it's proof of strength. They don't realize they're buying what the pros are unloading. Speculation always feels like genius while it's happening. People mistake luck for skill and profits for wisdom. Every chart looks like proof that risk no longer matters. The fear of missing out becomes stronger than the fear of losing everything. Ordinary workers become day traders, retirees chase volatile stocks, and students use leverage they don't understand. The market becomes a casino, and everyone believes they're the house. But casinos only exist because the house always wins. When speculation replaces investment, price detaches from value, emotion replaces logic, and hope replaces truth. Every uptick feeds the illusion, and every warning is dismissed as negativity. You just don't get it, they say, the same words uttered in every bubble before it bursts. The second horseman has arrived. Speculation transforms markets from tools of growth into games of chance. It rewards recklessness, punishes patience, and blinds the crowd to the risk they're actually taking. And when belief becomes the only foundation left, all it takes is one crack, one missed target, one failed IPO, one rate hike for the euphoria to turn into silence. The next phase is when that silence becomes dangerous, when delusion turns to doctrine, and people start to believe that this time is different. Every great bubble reaches its peak when people start believing the old rules no longer apply. It's the moment when reason dies and hubris takes its place. Economists, investors, and politicians begin to say the same 5 fatal words that have preceded every collapse in history. This time is different. In 1929, they said industrial technology had made recessions obsolete. In 2000, they said the internet had created a new economy. In 2008, they said financial engineering had eliminated risk. And in 2025, they're saying artificial intelligence and digital innovation have made crashes a relic of the past. Each generation convinces itself that it's smarter than the last, and that arrogance always comes before the fall. The experts help reinforce the illusion. Economists publish papers explaining why valuations don't matter anymore. CEOs tell shareholders their companies are redefining the future. Central bankers testify that inflation is under control, and financial journalists write glowing profiles of young investors who saw the opportunity others missed. The narrative becomes self-sustaining, a religion of perpetual optimism. The crowd believes it because it wants to. After all, who doesn't want to think they're living in a golden age? When prices only go up, skepticism feels outdated, even offensive. Anyone who questions the mania is labeled a pessimist, a conspiracy theorist, or someone who just doesn't understand innovation. The few voices of caution are drowned out by the chorus of confidence. Underneath the surface, the contradictions pile up. Companies with no profits are valued higher than century-old institutions. Borrowers with no income qualify for massive loans. Governments run record deficits while calling their economies strong. The distance between price and value, between belief and reality, stretches to its breaking point. But no one dares to admit it, because admitting it would mean the party's over. History proves that the phrase, "this time is different," is always the most expensive sentence ever spoken. It's what investors said before the Great Depression, before the dot-com bust, before the housing collapse, and before every crisis now written in textbooks. It's not just arrogance. It's denial disguised as intelligence. In 2025, the same language is everywhere. Market analysts call this the age of infinite innovation. Venture capitalists describe losses as long-term investments. Politicians brag about record debt as confidence in America. Even everyday investors echo the same line. It can't crash. Not with AI, not with this technology, not with this economy. But markets don't listen to narratives. They listen to math. And math doesn't care about hype, headlines, or human hope. The moment the numbers stop adding up, when the earnings don't justify the prices, when the debt can't fund the dream, the illusion ends instantly. The third horseman is always the loudest, because it speaks through confidence. The confidence that turns warnings into laughter, skepticism into ridicule, and arrogance into disaster. "This time is different," are the words spoken right before every crash, by people who should have known better and didn't. The next horseman is already approaching, because once risk disappears, the fall is no longer a question of if, but when. When markets rise long enough, risk stops feeling real. It's not that it disappears, it just hides behind years of calm and comfort. Investors mistake silence for safety. They believe volatility is gone forever, that central banks will always step in, and that the laws of gravity no longer apply. But gravity doesn't vanish, it waits. This is the phase of maximum danger. People stop preparing for what can go wrong and start assuming everything will keep going right. Insurance looks unnecessary. Diversification looks foolish. Conservative investing looks outdated. Everyone wants to play offense. Saving cash becomes missing out, and caution becomes a joke. In 1929, leverage was the drug of choice. In 2008, it was mortgage-backed securities. In 2025, it's margin trading, options, and leverage on digital assets. Tools so complex that even the people selling them don't fully understand how they'll behave in a real panic. But it doesn't matter, because in a world that only remembers winning, risk has become invisible. Ordinary people start quitting stable jobs to become day traders. Retirees shift savings into speculative tech stocks. Students borrow to invest. Everyone feels like a financial genius, not realizing that the system only works as long as everyone else believes it does. The entire market becomes a hall of mirrors, each reflection feeding the next illusion. Behind the scenes, pressure is building. Debt levels are unsustainable. Asset prices are inflated. Liquidity, the oxygen of markets, thus begins to thin out. It doesn't take a war, a pandemic, or a scandal to cause collapse anymore. All it takes is one small shock in a system stretched beyond reason. One missed payment, one failed bond auction, one major company defaulting. When that moment comes, the shift is instantaneous. What was once considered safe becomes toxic overnight. Confidence evaporates, and the same investors who mocked caution suddenly race to sell. But there's no one left to buy, because the smart money already left during the euphoria. Prices freefall, liquidity vanishes, and leverage turns small losses into catastrophic ones. The irony is cruel. The more people believe risk is gone, the more dangerous the system becomes. That's the paradox at the heart of every bubble. Stability breeds instability. Every measure designed to protect the market only makes it more fragile. And when the illusion finally breaks, It doesn't just destroy portfolios, it destroys belief. The fourth horseman, risk disappears, is never seen coming until it's already trampled everything in its path. Next comes the moment every investor dreads, the reckoning. The point where the crowd realizes that the ride is over, the music has stopped, and someone always has to pay the bill. That moment is the crash, and it's never gentle. Every crash begins quietly. It doesn't start with screaming, it starts with silence. A few stocks slip, a few investors take profits. The headlines call it a healthy correction. Analysts go on TV to assure everyone that the fundamentals are strong. It feels manageable, even normal. But beneath the calm surface, something irreversible has already begun. The first to notice are the insiders. They see the liquidity drying up, the credit spreads widening, the bids disappearing. They stop buying. Then, when prices drop just a little too far, the algorithms take over. Margin calls hit, stop losses trigger, high-frequency trading amplifies the fall. In a matter of hours, what looked like a dip turns into a spiral. This is how every collapse feels from the inside. Slow at first, then all at once. Retail investors rush to buy the dip, convinced the rebound is coming. They've been trained for years to believe the system can't fail, but this time, there's no safety net left. When the next leg down comes, it's violent. The screens go red. Trillions of dollars vanish in days. Fear spreads faster than any virus. The same optimism that pushed markets to the top now drives the panic on the way down. Investors who borrowed to amplify gains are wiped out first. Funds start liquidating positions to cover losses. Banks freeze credit lines. Institutions quietly move to cash. The crowd, too late, realizes they're the exit liquidity, and this is where the wealth transfer begins. It's not a conspiracy, it's arithmetic. The smart money sold near the top. The emotional money holds until the pain is unbearable. When panic hits its peak, the same institutions that caused the bubble start buying again, picking up assets for pennies on the dollar. It's the oldest trick in finance. Sell dreams to the public, then buy back reality at a discount. Governments rush to intervene. Central banks cut rates. Stimulus packages are announced. Bailouts are disguised as stability measures. The same people who caused the fire are hailed as heroes for trying to put it out. And once the dust settles, they call it a lesson learned. But the truth is, nothing changes. Each collapse is a reset, not for the system, but for ownership. The names of the companies may stay the same, but the hands holding them do not. That's why the rich get richer after every crash. Not because they're lucky, but because they understand the pattern. And as the middle class loses savings, homes, and confidence, the next generation grows up believing markets are rigged. They're not wrong. They're just late to the realization that in every crash, the few prepare while the many hope. The next stage is inevitable. The panic ends, the printing begins, and the same cycle that destroyed one empire quietly prepares the next. Because the pattern never ends, it only resets. Every crash feels like the end of the world, until the next one begins. That's the cruel rhythm of capitalism. Boom, denial, collapse, repeat. Each generation believes it's learned the lesson, that it's smarter, more advanced, more rational, but time always erases fear faster than it rebuilds wisdom. And so, the cycle never dies. It just changes its disguise. After every collapse, the same play unfolds. The media rewrites the story, turning yesterday's villains into misunderstood visionaries. Politicians promise reform while quietly protecting the same institutions that caused the crisis. Central banks cut interest rates back to zero, flood the system with new money, and call it stimulus. The market rebounds, the headlines cheer, and slowly, the crowd forgets. The trauma fades, but the structure that created it remains untouched. Within a few years, the optimism returns. The new bubble looks nothing like the last one, and that's why it works. In the 1930s, it was stocks. In the 2000s, it was housing. In the 2020s, it's technology, crypto, and artificial intelligence. Each promises a future so bright it blinds everyone to the lessons of the past. The narrative changes, but the mathematics do not. The truth is simple. Markets don't rise because humans get smarter. They rise because humans forget. The same greed that builds empires is the same greed that burns them down. History doesn't punish us for repeating mistakes. It punishes us for pretending we're immune to them. So when the next wave of easy money arrives, and it will, remember this pattern. Easy money, speculation, euphoria, denial, collapse, recovery. It's not prophecy, it's psychology. And until human nature changes, the pattern won't. Because markets don't crash, people do. In the end, no chart, no algorithm, and no policy can stop human nature. The faces change, the technology evolves, but the story remains the same. Greed, denial, collapse, rebirth. Every empire believes it's the exception, that it can outsmart the laws of history. But markets are the purest mirror ever built. They always show us who we really are. In 1929, it was overconfidence. In 2008, it was deception. In 2025, it's distraction. A world so obsessed with innovation that it forgot the difference between value and vanity. The data was there, the warnings were loud, but people chose comfort over truth. And in finance, that choice always comes with a price. When the next crash hits, most will call it unpredictable, a black swan, a shock, an accident. But you'll know better. You'll remember that the pattern was visible all along, that history was whispering its warnings louder than ever. Because the greatest secret of every financial cycle isn't how it ends. It's how easily people forget how it began. And as the markets rise again, somewhere deep inside the system, the first horseman is already saddling up.